Welcome back, everyone. I am Cas Piancey, and I'm joined as usual by my partner in crime, Mr. Bennett Tomlin. How are you?
I'm doing well. How are you, Cas?
Hanging in there. We're joined by a very special guest today, Patrick McKenzie, writer and expert in financial infrastructure and the author and operator of the newsletter Bits About Money. Patrick McKenzie, how are you today?
I'm doing very well, everybody. And before I get started, I have to make the obligatory disclaimer. We're going to be talking a lot about payments today. I previously worked at the company Stripe, which does, as many of you know, quite a bit of payments for 6 years, but I'm speaking entirely on my own behalf, even though I'm still an advisor there in some capacity.
I think it'd be a good place to start just in payment infrastructure, like financial payments infrastructure. You're an expert in that. Do you want to talk about how you think cryptocurrency fits into payments and finance in general, and perhaps some of the issues that you see with it?
So let's take a step back for the moment to talk about payments generally speaking. The economy is this overwhelmingly complex machine that includes a lot of various actors that are bouncing off of each other and exchanging value. Typically, a transaction will involve one business and generally a customer of that business, whether that is a business customer or a consumer customer, these three handsome blokes that are doing a podcast about cryptocurrency. Transaction typically takes multiple steps, and that exchange of value is actually kind of complicated when you get into the details about it. You might think some are pretty simple. You go up to a cafe, you get a cup of coffee, and you hand over your money. But some of them, they involve an invoicing process, a multiple month contract negotiation, et cetera, et cetera. And so a payment happens as an important part that is very much not the whole of the part, which is an adjunct to these transactions, an adjunct to these customer relationships. And all payment is a message between the customer, the payee, and the business that tells the business something that is useful to know about whether they will ultimately receive money for the good or service that is under issue. Typically, the form of the payment encodes some information as to the level of certainty the business should have that it will ultimately be paid about this. And kind of the most interesting thing that payments as a field has ever done is convincing people that a payment is actually much more than a promise, that there's, math and infrastructure and yada, yada, yada. And there is math and infrastructure and yada, yada. But at the end of the day, all payment is a formalization of a promise that could have been made on words or paper or via smoke signal.
Could you walk us through an example or prototypical payment just to show how the payment itself is a promise and how that works kind of in practice?
I will disclaim at the start that everybody who works in payments or crypto or the finance field grew up in a particular place, perhaps many places, and they often filter their views on the field through the experience of that particular place. And when you look at payments worldwide, the various different payment methods have very, very different user experiences and sort of ergonomics associated with them. Let's use the world's most terrible payment method, and you can make a long list of payment methods that are vying for that crown. But I would claim that the system of checks in the United States is a system of payments that nobody would invent in 2023 because it is unsafe for all possible use. But it's a good thing to get a mental model for how payments used to work. And so back in the day, you go into a grocery store, you pile up a basket full of groceries, you take them to the counter, and when you pay it a check, all you are doing is saying, "Hey, grocery clerk, the total comes to," well, it was back in the day, so it was probably $16. And I promise to pay the grocery $16 for this here basket of groceries. And actually, prior to checks being much of a thing, that was the end of the payment because the promise was literally that. It was a promise. The grocery store would just increment your account by, okay, you owe us $16 more than you used to. And then a few months later, you would go there and pay cash or specie or beaver pelts or whatever it was. But when the grocery stores largely tried to get out of the extension of credit business, they would say, okay, give us a check. And a check is still an extension of credit. All it says is, okay, that verbal promise that we used to make that I will pay you the $16, I'm going to write that promise down here on a piece of paper. And this promise and this piece of paper are magic because you can take this here piece of paper and this promise on it and hand it to my bank, and my bank will hand you 16 actual American dollars in behalf of this. And importantly, despite that being the transaction, the grocery store almost never actually did that. What the grocery store would actually do is take the promise over to their bank, which is typically not the customer's bank, and they would say, "Hey, this person has promised to pay me $16. And the customer's bank would say, "Well, golly gee, it looks like another bank has promised the bearer of this instrument here $16. You can deposit that in your account. I will credit you $16, perhaps today, perhaps 5 days from now. It doesn't really matter. And then I, the bank that you bank at, am going to go to the customer's bank and say, hey, the customer has made a promise for $16. I would like to collect on that promise in satisfaction of this credit extension that I have made to my customer." And then you layer on that like fascinating Rube Goldberg contraptions of the infrastructure built to support this. Used to be back in the days that there were massive courier operations between different banks attempting to carry like literally tens of thousands of checks a day between them, because the check was only actually good at the particular institution written on the check. And then we developed this clearinghouse infrastructure where everyone said, it is crazy that every bank needs to send out 4,000 couriers a day to 4,000 other banks. Why don't you send all the couriers to just one place in the middle, and they will do the math and handle this for everybody. And then they made that clearinghouse system electronic. If you've heard of ACH, it's the automatic clearinghouse. The automatic stands for computers involved. And we've had, progressive layers of infrastructure built on top of that, like fundamental, terrible, the check is a promise written to physical paper infrastructure. By the way, why is a check a absolutely terrible payment method? We would never design a payment method in 2023 that had all the secrets necessary to steal all the money printed on the face of the payment method, but a check factually does have all the secrets necessary to steal all the money printed on the face of it. And so anytime you give a check to anyone, both the person you are giving it to and anyone who even glances at that check for one moment can debit all of the money in your bank account. And the reason that doesn't happen constantly is because banks are extremely aware of this terrible decision made several decades ago and constantly squashing attempts to do that. Anyhow, that's a brief simplified understanding of the huge amount of societal effort that goes into the back office of simply trying to buy $16 worth of groceries. Now scale that up to there are many different competing payment methods. You're probably very familiar with credit cards. You're very familiar with various forms of bank payments. They undergird essentially all of the economic activity in the economy. One can quibble on whether cash is a payment method used in this case, but cash is a relatively small portion and decreasing portion of payments in the economy, and getting smaller every year in most markets. There's variety of reasons for that. Happy to go into them. But payments is this giant, multifaceted infrastructural beast, which is hugely interesting to do deep dives in. I heard crypto got mentioned somewhere in this podcast. Maybe I should talk a little bit about crypto.
I do want to delve into that a bit. I think that's a good statement right there, because I am actually a huge fan of physical cash. I resolutely mention this all the time on Twitter. And Bennett, when he visited me out here, knows that I was using it to pay for gasoline and things that most people do not use cash for. Why is cash dying? What do you think? And what do you think will come to take its place?
What are the downsides to cash? Why is cash dying? The fundamental reason cash is dying is because every payment method exists in competition with every other payment method for business. They want to get business from the businesses that are selling things. They want to get business from the customers that are paying for things. And the reason cash is losing share against other payment methods is because other payment methods give people a variety of benefits that they can't get from using cash. Other payment methods, credit cards will offer to give you reward points, so the cost of doing a transaction is literally negative, where most customers would say that the cost of doing a transaction in cash is zero. It's not actually true, but from the perspective of most customers, that rounds to true. The ergonomics of using cash are painful. You have to count out change, et cetera, et cetera. The cost of using cash for businesses is much higher than people believe it to be, because you need to actually count it, make sure it's not stolen. Cash doesn't have most payment methods have built-in infrastructure to track the relationship between a payment and between the customer who made the payment and the transaction that the payment was made for. Cash doesn't have that built-in infrastructure, and so every business in the economy that touches cash needs to build their own software, accounting, and contractual infrastructure in place of the stuff that they would ordinarily buy from Visa or their bank or PayPal or any other provider of a payment method in the economy. So that is fundamentally the reason why cash is being outcompeted. I don't expect cash to go away. Some people like it. 2 thumbs up. You do you. But people often say, "Oh, it's a conspiracy. The government wants to get rid of cash." One, the difference between conspiracy and policy goal is a matter of degree. Like if you were to go to Japan and say, "Is it a conspiracy that the government wants to get rid of cash?" They would say, "Oh, there's a position paper that we have on this exact subject, where currently the percentage of cashless transactions in the economy is plus or minus 20%. Our goal is to get that to 40% within the next 5 years. Here are the initiatives that we have going on with the financial industry to do this goal. The reasons why we have this goal are, 1, we think it will decrease the tax gap, particularly with regards to small businesses. 2, we think that this will help modernize Japan and allow us to engage in more international commerce. 3, ... So, the fundamental reason why any business's fortunes go up or down is their position in relation to competitors, and cash is just, not what you would come up with in 2023 for a payments experience that is destined or, designed to gain share versus modern payment systems.
I mean, this leads us into the cryptocurrency debate, I think, a bit here, is that with the death of cash in general, for a multitude of reasons that are totally fair and reasonable when it comes to the future of money and the current state of money. Do you think that the future is closer to, let's say in China, I know everyone uses like WeChat or some sort of centralized social media app to usually pay for things. The way anyone is known as a tourist is less whether they know Chinese, know Mandarin, and more if they have like WeChat and a bank in China that they can use to pay for this stuff. If they're using cash, they're a tourist. Or do you think it's something closer to cryptocurrency where you have it decentralized to a degree, or centralized kind of stablecoins, which are cryptocurrency, I guess, right?
I think one of the interesting things that looking at payments will give you for a glimpse on the future is that there isn't one future for the world of payments. We are likely have multiple different equilibria in multiple places. It is always difficult to look in the crystal ball and predict the future, particularly for a country where one is less invested. But if I were to, be in the crystal ball business, I would say, it does look like China will increasingly go in the direction of a very small number of payment systems that are nominally privately administrated, which are as nominally privately administrated as anything else that exists in China. And those systems will broadly be, fully electronic, not touch cash, and be relatively separate from the formal banking system, unless and until the Chinese government decides that it would be more advantageous for them to be in the formal banking system, in which case they'll be in the formal banking system immediately. That equilibrium doesn't prevail in other places. So in many markets, there is a Cambrian explosion of competition between payment methods happening right now. And so I'm something of a gamer until recently. I lived in Japan. And if you were to go to Steam right now, Steam lists 15 different ways you can pay that for, video games in Japan. And 15 is actually a small segment of the Japanese payment market at the moment. If you go to a convenience store, the number of logos they have on the door will be plus or minus 40. And 40 does not touch the entire market. That's just the teams that were smart enough and big enough to get the largest convenience store chains in the world to accept their money. That's a very different experience from what we have here in the United States, where for the longest time, the payments industry thought in the United States that the credit card was the final evolution of payments in the United States. And that all interesting work in payments heretofore would be different variations on, let's make it a reward card. Let's put different credit terms on it. Maybe we can make a credit card and take off the credit part and call it a debit card. And that will allow us access to a new market, et cetera, et cetera. And then just in the last few years, there's been innovation both within the United States and coming from places outside the United States, greatly impacting the U.S. market with respect to things like buy now, pay later as an offering, where they said, we can entirely take out the credit part of this, or rather take out the card part of this, make it palatable for the merchant to underwrite the credit extension, and knock down the cost of credit to zero for the customer, and work the numbers such that this works out for everybody. And we see, different things in places like India, where India has a public-private partnership that has sort of like the platonic ideal of what people who say central bank digital currency. Like most people who say central bank digital currency care probably less about the slow database involved and more about like the fundamental user interface involved, where like any person in the economy should be able to pay any other person in the economy at an arbitrarily low cost. And India rolled that out with their sort of public-private partnership payment method that is tied to individuals' identity cards and et cetera, et cetera. Brazil also has an option called PIX, which is spiritually similar, although it has some important under the hoods differences. And in India, like virtually no one has a credit card. And, given a like really strong publicly endorsed alternative payment method, I think one would probably be bearish on the perspective of like India, credit cards in India as a payment method capturing the majority of share in that country. But who knows what the future holds.
What do you think the largest unsolved problems in the payments industry still are?
Oh, there's so many of them. This surprises a lot of people. But the largest and most sophisticated businesses in the world hate money. And why do I say they hate money? It's because they have a team that's in charge of payments. The team is in either an organizational backwater at their company, or in many cases doesn't work for their company. They work for a middleman or a systems integrator or an Accenture or similar. And the actual interface where their customers come and pay them literally all of the money is like, in some cases, it's literally a particular web page you can click on. In many other cases, there's a million different interfaces, all flawed in their own way. But that, like, the actual experience of a customer attempting to pay is broken profoundly in so many different ways. Like, in the same fashion that science can demonstrate that cigarettes cause lung cancer, this web page causes you to lose billions of dollars. And that persists. And so that, like, the high-level biggest problem in the world for payments is that the adoption story of it for businesses is just tremendously suboptimal relative to their goals for it. You can also say the same about the adoption story for individuals. Quite a bit of the general distaste for banks and et cetera is ultimately transactional friction around like routine transactions in the economy that the parties expected to go well, that didn't go well for various reasons. And then, you need someone to blame for that going badly, and for whatever reason, the banks end up carrying the ball. Sometimes extremely deservedly, but other times it's just because we haven't figured out a way to, at a societal level, deal with conflicts between renters and landlords, for example, in a way that doesn't bring the payment method into it. And indeed, that is actually one of the things that payment method offers to the world. We have this gigantic society-wide system for resolving disputes between people involved in commerce. It's called the legal system. It is galactically slow and galactically expensive. And the thing that payment methods offer is to say, okay, you will always retain the right to go to the legal system to argue over this $16 basket of groceries. But neither you nor the grocery store wants that to happen. And so if you use your, debit card to pay for the groceries and an apple spoils, and you go to the grocery store and can't get a HAPA resolution with regards to your apple, call the 1-800 number on the back of the debit card and say, I am unhappy, and you get your money back. And there is this massive machine in capitalism that exists to guarantee that invariant for you. You don't have to care about that machine at all. You just have to know, call the 1-800 number on your debit card and your problem goes away. And you don't have to pay $600 an hour for a lawyer to fight this case in court for 4 months, because no one wants that to happen.
How much are these experiential problems in payments tied to the infrastructure choices that have been made so far? The building it up from checks to this automated clearinghouse to this various small kinds of credit on top of it. How are those related to these experiential problems, or are they related?
They're extremely related. The word we like to use a lot is path dependency. Many people in the United States and many people in the crypto industry who are heavily exposed to the United States think that transfers between bank accounts, they take forever, and to the extent that they don't take forever, they still take like way too long for a computerized transaction and then cost a lot of money if you're doing wires. And all of those are path dependent. They're because transfers between banks in the United States is ultimately based on this model of like sending checks from one end of the country to another, of like various iterations we made on top of that model. There are reasons why those iterations persist. The banking industry does not lack for smart people. It turns out that when you're dealing at the scales of the economy, things that you could do that would make like certain aspects of these better for some people also create losers. And society has both like, negotiations between firms and also negotiations at a society-wide level through the government on like, we want a compromise here because we, do want to allocate like the winners and losers in a way that achieves society's desired political/moral/ethical goals for them. And so as an example of that, one reason that payments is slow in the United States isn't because anyone is pounding the table and saying, slow payments, man, that is what we need for the world. What they're actually saying is community banking, man, that is really important for the world. It is like extremely important that a person in rural Nebraska has a point of presence nearby that they can ask questions of about the financial system and about their relationship to the government, which is brokered through the financial system. That requires community banks to exist. For various reasons, community banks would find it very difficult to continue existing in a world where all payments were substantially instantaneous. That would result in lots of them going under due to operational risk and technical risk that they can't take on right now. We can't bankrupt a third of the US financial system, and so we need to have due deliberation in having instant payments being available, which is one reason for many of the negative news stories regarding Zelle, and it's one reason why FedNow, the real-time net settlement payment method that the Federal Reserve has had in the cooker for a while now, has been sardonically referred to as FedLater for the last couple of years.
I'm hit with two questions here, and feel free to answer whichever one you think is more reasonable. But one, I think we're talking about the payment infrastructure, and I wonder if the payment infrastructure is also hindered by something that we've all kind of accepted as normal now, which is KYC AML. But KYC AML was only really introduced within, my lifetime, like I in 2001, after 9/11. So KYC AML is a relatively new construct. I wonder if that actually does slow things down on purpose as a policy goal, or the other side of this that I think is relevant to what you were stating is that you're talking about community banks, you're talking about kind of the banking structure of the United States. And I know that we have a lot of banks here, or things that are close to banks. And I wonder if we're watching that kind of collapse now, and if that indeed will change the payments infrastructure in America.
One, it is not the case that Know Your Customer, KYC, or AML, anti-money laundering, regulations started in 2001. They were refined by the Patriot Act in 2001 in the wake of the 9/11 attacks. But the sort of legislative history of them dates back to, I believe, the late 1970s in the United States under what's called the Bank Secrecy Act, or BSA. And the Bank Secrecy Act basically says, like, banks, please have less secrecy from government. But originally encodes the notion that banks are required to have for their accounts which have an ongoing relationship with the customer, you need to discover what you believe the true identity of that customer to be and persist information about that customer and their identity for the lifetime of the account and sometime after. And all KYC kind of like flows from that original fount in the United States. In an international point of view, it's kind of complicated because there are these supranational, quasi-judicial, quasi-private organizations that promulgate KYC standards, which are like somewhat rubber-stamped by various international treaties and government policymaking, and sometimes sort of like adopted by the banking infrastructure, less because their government has said you legally must adopt this thing, and more because they don't want their wires, like the physical copper wires, to other nations getting yanked out at the source. So there's a big ball of wax there. But clarifying that, I think it is useful for more people that are involved in cryptocurrency, for example, to like understand that the genesis of KYC and AML dates back to a while ago. Does that intentionally make payments products worse than they would be? This is a complicated topic. One thing that and if folks haven't followed me for a while and haven't like gotten this impression already, I'm something of a crypto skeptic myself. More than something of a crypto skeptic. I remember back when Bitcoin was $17 saying that it was overpriced by $17, and I have not seen any evidence over the course of the last 10 years to change me from that point of view. Be that as it may. A thing that the crypto folks are like fundamentally right about is that AML and KYC regulations are a matter of choice for society. Society should choose them to the extent that it believes that it advances society's instrumental goals and achieves our values. And to the extent that they don't achieve our instrumental goals and values, we should like change the AML/KYC regime. AML/KYC creates winners and losers. One of the things that you hear over and over again in talking to people who are unbanked or underbanked, and that you will see in the scientific literature about this sort of thing, is that the difficulty of formally verifying one's identity to a bureaucratic process causes people to not be able to open bank accounts, and that's one of the reasons that they remain unbanked or underbanked. That's negative to the extent that we want everyone to be able to partake in the economy on equal footing and to be able to like trivially do things like order from DoorDash. That both is true, but it's not like the entirety of the story. Often that gets blamed on AML/KYC, where it is not actually required in the regulations that it be difficult to demonstrate your identity to a bank if you are, for example, an immigrant in underdocumented circumstances. But banks are like kind of okay with a maximally sort of risk averse version of their AML/KYC policies, because it turns out that sort of tightening the dial on AML/KYC improves their metrics with regards to operational losses and fraud losses. That, by the way, is another thing. Like independent of any so obviously nobody's in favor of tax fraud and nobody's in favor of terrorism. Goes kind of without saying. But AML/KYC don't only impact tax fraud and terrorism, and in fact they probably impact those a little bit less than the drafters of the policies think. But they also, the notion that like every credit card has an identity attested to with like some degree of credence to it causes having a credit card to be an excellent risk signal for a variety of businesses throughout the economy, whether that is a e-commerce merchant that is sending you a PlayStation 5 in the mail, or whether it's a hotel that you're checking into, which is trying to like run a process on every customer that checks in. Are you going to be the one who invites in a prostitute and then sets the bed on fire? You coming up with a credit card in your name to check into the hotel says fairly persuasively to most hotels on the basis of a whole lot of historical evidence that this will not be the person that burns the hotel down.
We're watching the collapse of regional banking, or we did see a significant collapse of regional banking in the United States with First Republic, Silicon Valley Bank. We saw Silvergate go under. We saw Signature. It seems like this hasn't quite finished yet, that there's still going to be more banks that suffer, more banks that come to the same realizations that maybe they've got a balance mismatch. And I'm just wondering if you think that could change the fact that there could be a shift in community banking services and regional banking services in the United States in the next few years. Do you think that could alter payment processing services?
There's both the concrete, what we actually expect to see in the United States spool out over the next couple of years version of this. And then there's also kind of like the, if everyone were spherical cows like we have in physics classes, what would you expect? The spherical cows version is that society ultimately has goals for the structure of the banking system. One of the goals for the United States having such a vibrant community banking sector is that it helps bank the I forget the numbers off the top of my head, plus or minus like 50% of the United States who lives outside of a major metropolitan area. That might actually be like 20 or 30%. But helps them get access to a local point of presence for the financial system and for their government, which interfaces with them through the financial system. When I say that kind of glibly, that means your bank is the place where you pay taxes, and your bank is the place where you get government benefits checks, et cetera, et cetera. It is another branch of government in all but name in a lot of ways. Historically, it was broadly believed that if there was not a physical bank branch within a reasonable travel distance from your house or workplace, that was a bug that the system should fix. In the same way that the system, the United States of America decided as a policy priority, we don't care where you live in the United States of America, you are going to get a phone line and you are going to get electricity because the standard of living that we expect for Americans will in the future include a phone line and electricity. And that happened in people's living memory, by the way. They'd be very old at the moment, but the Rural Electrification Act, there are some people who were alive before the passing of that act. What if it is not actually true about the world that we need a physical bank branch around you to give you banking or bank-like services? What if that can be delivered more efficiently through the internet? What if the thing that people have wanted for forever in the advocacy space, postal banking, let's put a bank in every post office, can be delivered much more efficiently? Let's just put a bank in every iPhone and every Android, and that will be like the basic bank account available to people. And they can layer on like more complicated banking services, potentially including a branch if they want them. But from a perspective of like the bare minimum thing you need to exist in a society exists on every phone. I think that in a spherical world is like a very reasonable thing to expect, that most banking, particularly at the lower ends, is going to be intermediated by various players like, for example, Cash App, which Cash App is not a bank. I'd be a very bad financial technologist if I said Cash App is a bank. But let's say Cash App is, from the perspective of an unsophisticated consumer of banking services, a whole lot like a bank if you squint at it. That isn't a criticism, by the way. I think Cash App is a wonderful thing to exist in the world. That it's probably one of the best things the technology industry has shipped in the last 20 years. I don't work for Square or Block or whatever they call themselves these days, and never have. They're just, that existing, like, 2 thumbs up guys. Now let's talk about, like, in the world we actually live in, what will happen over the next couple of years. Community banks aren't going away. Regional banks aren't going away. And I do believe we're in a bit of a banking crisis at the moment. Banking crises are not good things for the world. Nobody should celebrate them. But this one seems to be less severe in scope than previous ones that we have weathered and, come out the other side as a nation/economy. Sort of addition to issues such as the, retail facing experience for like basic payments, and you need someplace that isn't your mattress to hold money. Banks often they also have a very important credit creation and monetary creation function inside the United States economy. And those functions aren't going away, and they can't conveniently be substituted by any other player at the moment. So, every apartment building, every dentist office, et cetera, there's a capital stack behind that, and that capital stack in almost all places outside the big cities for almost all buildings materially involves community banks or regional banks. And it would be a catastrophic outcome for the United States of America if that was not true, because of the way that we have our banking system set up. Now, again, there are many equilibriums that you can, imagine different countries falling into in the world. Like if we look over at our friends in the UK is in a lot of ways a near peer to the United States. And the UK has like basically 4 banks, and they're cool with that. That's one way to do it. Japan has a system that is closer to the United States in character, in that there are sort of like large money center banks and also smaller community-focused institutions. But these quote-unquote small community-focused institutions are much larger than they are in the United States, and they're far less numerous on a per-population basis. These are multiple equilibriums that we ended up in due to a variety of straight up geographic factors, due to historical factors, due to this path dependence that we're on. And the transition the United States would have to undergo to go from having more than 6,000 financial institutions to having, let's say 200 financial institutions would be basically cataclysmic and unthinkable. So I don't expect cataclysmically unthinkable things to happen in the course of the next 5, 10, 20 years.
The thing I hope to kind of get at with this episode is why cryptocurrencies, at least generally, don't solve most of the problems people have with payments. And I think what I've been hearing from you over these last 30 minutes is that most of our payments infrastructure is built around managing the trust of various actors in this entity and making sure that things behave in a repeatable way that is reasonably acceptable to most of the participants in the system. As we've been going over that, it has just been reiterating in my mind how different that is from the goal of like cryptocurrency as a payment method. All of this infrastructure you're talking about isn't really about transferring the actual dollars from point A to point B. At least most of the stuff built on top of it isn't. It's about managing the expectations about everyone who needs those dollars or has them. And cryptocurrency people always focus on the actual transfer and specifically focus on trying to make that a transfer that can happen to anyone, like at any time for no reason. And I think what's becoming clear to me as you're talking through to this, or becoming more clear to me, is how often that would fail for most payments use cases. You were discussing the example with the grocery store, and just a normal person trying to buy a cart of groceries discovered the cart of groceries was not up to their satisfaction for whatever reasons. In a world where cryptocurrency is the default payment method and you're using it in the way most crypto advocates would expect, you don't have that option to call the 1-800 number. You need to go back to the grocery store and try to convince them they should give you your money back. So what it really looks like to me in a lot of ways is cryptocurrency people saw one of the problems of the financial system, meaning that sometimes these entities slow payments, stop payments, or will not allow you to be one of their users who makes payments, and decided that that was the largest problem in payments and set about solving that, and assuming once that was solved, everything else was solved. Does that match up with kind of the tension you see between what crypto advocates think is wrong with payments and in your experience, what is actually wrong with payments?
I tend to think people think that I deserve more trust than I have. So you shouldn't take my point of view as gospel on this one. Like, I don't like McDonald's burgers, flat out. I would do many things to avoid eating a McDonald's burger. But we can observe the universe outside of us and see that a lot of people like McDonald's burgers for a lot of purposes. Now, we can observe the universe of crypto payments, which exist in like crypto people have been saying, adoption is coming any year now for about 10 years. And, buy now, pay later could say the same thing. And yet buy now, pay later, like you can actually use that to pay for stuff at Sephora if you walk into Sephora today. You can't use Dogecoin, you can't use USDC, et cetera, et cetera. Why is the market telling crypto, thanks for this cool, slow database? It doesn't solve problems for me. I will not put it on my payments website. I will not use it to transact with Google, with Delta, with Hilton, with McDonald's, with all the other businesses I transact with. It's because crypto kind of like maniacally focuses on that settlement part of the payment experience and not on the many, many other things that payments brings to the table. Some of those are about money movement. Frequently, payments is bundled with things that are not directly about money movement or the software and contracts that make money movement go. And so a pitch from the credit card companies to every other user in the ecosystem since time immemorial has been, the reason you pay for credit cards is not simply a convenience fee for getting cash from their pocket into your pocket. It is because if people use our plastic, the people that come in bearing our plastic will be the most desirable customers, and they will spend more money on our plastic than they would if they were using something else. And since you prefer more money to less money, you should be willing to pay a convenience fee for that, just like you're willing to pay for example, advertising. Thing that many people don't appreciate is like different credit cards have different prices for different businesses in the economy. So, for example, if you use not an endorsement, et cetera, not using any private information, if you use the Chase Sapphire Reserve. Chase Sapphire Reserve is like sort of the credit card of choice for professionals in the Bay Area. Why? Because they give a lot of points and are very nice to their customers. Creating the Chase Sapphire Reserve required Chase to get in touch with, I believe, Visa and say, look, you've got existing tiers for like different Visa cards, and they get more expensive for businesses as you go up in tiers. We need an entirely new tier because we're bringing an entirely new primo experience to the Visa ecosystem. And that tier is like materially more. It's like, I can't remember how many basis points it is, but that is Googleable. And it's like 60 basis points. So 0.6% or 1% more expensive for businesses to take a Chase Sapphire Reserve than it is to take the next tier of Chase card. Why? Because like they successfully got it into the hands of a bunch of rich people in New York and San Francisco and many other places. And when those people like pull out the card at the top of their wallet, they spend a lot of money, and businesses like transacting with rich people for a lot of money. And that is a thing that can be bought and sold in the economy.
I don't know that I realized that before today, that like credit card fees were different for different tiers of credit cards, because normally when I've been seeing it, it's abstracted away, right? I'm looking at, say, Stripe's example, and they're charging 2.9% plus 30 cents or whatever. But that then is like an aggregate with their margin based on like the distribution of fees they're paying to the credit card networks specifically.
A good like heuristic for thinking about this is like, what is the price of coffee? Well, coffee is like 25 cents if you buy it at a diner, or it's free if you get it on an airplane, or it's like $6 if you get it from a Starbucks. But if you buy like 50 gallons from Starbucks at a time, they will cut you a deal. But if you buy those 50 gallons in the specific context of, delivering them to a hotel event space, it will suddenly cost you like 5 times more than Starbucks would have charged you. And this is all just like built into those various commercial relationships and ways to deploy it. So what is the underlying cost of like charging a credit card? Well, it kind of depends, like, who you are in the economy, what sort of relationship you have, what other things are getting bundled into that transaction. If you are Walmart, you don't pay the same amount for charging even a Chase Sapphire Reserve as, for example, I do if someone uses that to buy my newsletter. And partly that's due to like different levels of negotiating power. Partly that's due to things like, providing financial services involves like a variety of different goods. Like, you need a 24/7 phone team and an ops team, et cetera, and it's difficult to bill for those things directly. The economy went away from a model in which most companies said, okay, it starts like it's $100 a month for your basic charge to get hooked up to international financial rails, and then we charge you like a per percentage fee. And mostly, with like some holdouts, the financial system has said, actually, like that $100 a month, we're going to absorb that. We will pay for the ops team, we will pay for the customer support people, et cetera, and we will adjust our percentage rates in various places to like have the entire business work off of transactional fees or software fees, or et cetera. That pricing story would be an entirely different podcast, hopefully by an entirely different person who isn't constrained by having like written so many documents about it. But it's a useful thing to know in the world. By the way, so probably not new information for you, but will be new for many of your listeners. There's a greatly different cost in the cost to process credit cards versus the cost to process debit cards. And that was created largely due to financial regulation in the wake of the 2008 banking crisis. More or less, and I don't know if this would be endorsed by many other people as a way of saying, darn it, banks, you screwed up. We are going to hit you back as a result of that. And again, when our elected representatives were saying, banks, you screwed up, we are going to like punch you in the face and decrease the amount of money that you can earn from debit cards. The Community Banking Association put their hands up and said, okay, you can do that to Bank of America, you can do that to Chase. They will continue existing. But we find it extremely, extremely useful to have material interchange fees, they're called, for swiping debit cards, because that is like built into the cost model of providing banking services in middle America at the moment. And if you take away, that will collapse, and society-wide calamity will follow. And so there was the Durbin Amendment to the legislation about this, which said basically there's a threshold. Above that threshold, you are a big bank, and you are not allowed to charge very much at all for swiping debit cards. Below that threshold, you are a Durbin exempt bank, and you're allowed to charge quite a bit for swiping debit cards. And that was a choice society made through our elected representatives. And then the choice has knock-on consequences. Like if you, for example, use Cash App. Cash App has a debit card offering available. I would guarantee you that debit card is issued by a Durbin exempt bank, because Cash App likes the idea of being paid a lot of money for doing their debit cards. And indeed, if you look at almost any fintech offering, their debit card will be issued by a Durbin exempt bank because of money. And people like hear that and think, oh, that's right, regulatory arbitrage. That nobody expected that to happen. True, no one explicitly expected that to happen. Not necessarily a bad thing, though. I mean, if to the extent that we believe that like Cash App banking underbanked people throughout the United States, or I can't believe it's not banking underbanked people throughout the United States, actually provides societal value, that like an economic model which makes that possible for Cash App to do without charging the end user of Cash App directly for it is like positive in some respects. And the like flurry of additional fintech, financial technology products that are where a material part of the model is underwritten by these Durbin exempt debit card charges has provided some amount of customer perceivable value in the last couple of years. And so, if you were hypothetically a regulator or the staff at a congressional office looking at like, oh, there's this like weird little thing that happened in the Durbin Amendment to this legislation back in the day, which seems to have these like huge knock-on consequences that weren't intended. Should we maybe like poke at that a little bit? Like you'd have to understand that, okay, that, due to this past dependence, that has also created like a huge amount of things that are now hanging off that amendment, and like just nixing it would cause consequences in the real world.
You brought up like a Chase credit card as an example of like, well, people in the Bay Area like the specific things that they get with this card. You're talking about regulatory arbitrage now. I wonder if everyone doesn't wish that they could also provide those same kind of offers to their customers. If every bank doesn't wish that they could do that, they're just not able to. And almost like I think about what happened with Silicon Valley Bank, and it's like it's almost like they were desperately trying to become Chase. Like that was the end goal of their business model, sort of like this idea of we just need to keep growing. And I guess I wonder if that's a pitfall, because then the only real business model for these smaller banks is to constantly grow. And like, is that what we want in the community banks, in these smaller organizations that are supposed to be for the people that they're around, the community that they are centered around?
I'm a little bit constrained in what I can say about like any individual bank in the banking system, partly due to reasons of being exposed to them due to prior employment, and partly due to like the unfortunate social reality that banking is a very small world when you get down to it. And there's like probably someone who is control effing all mentions of their bank today and will send out nasty grams to anyone who says the wrong things while occupying the wrong social position. That's not a conspiracy theory, by the way. I was one of those people in a prior life. One, the United States has had a number of bank failures in the course of 2023. The banks that failed were largely not community banks. They were largely not tiny institutions that banked grandma and the little league team. They were large regional banks, with 1-2 exceptions, that would, on a global scale, be among the largest banks in the world. And some banks prefer growth there. Many large, sophisticated businesses prefer growing versus not growing. Financial regulators and bank CEOs at community banks would say that they prefer measured, steady, sustainable growth, and that growth which is not measured or steady is likely unsustainable and likely conceals risk for the banking system. And so, that should be dispreferred. Smarter people than me will look at the actions that regulators took over the last couple of years with respect to some banks that are no longer with us and say, was there an identifiable person in an identifiable office who could have made certain identifiable choices that are different, that would have resulted in like the United States having a different number of banks in 2023 than it actually does? And maybe some decisions that were made in prior years will be rethought in that light. Stripped of euphemism, there was a bit of failure to go around there. There are banking management teams that did not apparently do a great job of banking management. There are banking supervisors who should not be captured by banking management. That's the entire point of being a supervisor, who did not do a very good job by society's lights with respect to the goals that we have. And we required extraordinary intervention to ameliorate the societal fallout of failures of banking supervision, also failures by, the banking teams, the risk departments, yada, yada, yada. There's also like external to banking supervisors and the banks. Can one look at the Fed and say, hey, we understand that it is a important societal goal to get inflation under control, because obviously Americans, as of many people worldwide, have been really feeling the pinch in the pocketbook the last couple of years. So that's important. However, you also must not collapse the banking system while you are doing this. And if you look at the written record, we told you that if you keep moving rates up very, very quickly, you will collapse the banking system. Do you remember reading those documents? And that, like, smarter people than us will have to have those discussions, but society does have to have those discussions at some level.
I know you can't speak to specific banks, so I'm not going to ask you to. But I know Cas can speak to specific banks, so I might ask him. One specific bank that we have covered was Farmington State Bank up in Washington State. And this was a small local bank. Their primary function was extending credit to farmers in the local area who needed it to fund a piece of equipment that had a predictable impact on their business. And this bank being embedded in the community was better able to provide that services than others. And it was taken over by a new management team who had ambitions to transform this small community bank into something much grander. And they believed that with the appropriate partners and the right investment from Alameda Research, they would be able to take this bank and the deposits from Alameda Research and turn it into the future of online banking and all those things. And so when Cas was talking about banks that felt compelled to grow, that was, of course, the example I was thinking about. And I couldn't help but think about the Federal Reserve cease and desist letter issued to Farmington State Bank after...
A wonderful document. I would recommend to everyone.
Yes. Issued months after they had already discharged the problematic deposits in question and had already begun the process of being acquired by a different, slightly larger bank in that region. The Federal Reserve finally got around to issuing their cease and desist that says, wait a second, you guys did a whole bunch of things over those years without telling us. Well, that's not okay. And it was a funny document to read, both because it highlighted how many things that this bank was doing that was apparently against the rules without anyone realizing it, and the fact that the regulator didn't issue this document until months and months after any danger from Farmington's behavior was already passed. And that tension that case has always been one that's stuck in my mind since we've covered it. I could see that you have thoughts on this case, Cas.
Well, yeah, I want to let Patrick jump in here, but I just wanted to say that it's funny that you brought up the cease and desist order, because I reached out to Bank of Eastern Oregon. I think that's the one that bought them. Or Farmington got purchased by this bank. I reached out to that bank on the day of the cease and desist letter. And they basically were like, yeah, well, this is no surprise. We knew this letter was coming.
Well, yeah, it was filed explicitly with their knowledge and consent or whatever. It was said, as they've already consented to, as agreed by whatever.
And I think this is my point, just being that Farmington knew this cease and desist was coming as well, right? Everybody intimately involved with the bank itself, or the purchase of the assets of the bank, or, whatever it was, whoever was intimately involved, knew that the cease and desist was coming long before anyone in the public did, which almost speaks to the weird regulatory nature of the Federal Reserve, where you go so who was this for?
Let's step back from the specific example of a specific bank that might have been puppeted by a specific bank that does a lot of business with other. Maybe I'm letting a little too much show there, but let's step back from the specific example and talk more broadly about banking regulation. So one example of who is this regulatory action for? It's every regulatory action will have an address on the top of who is supposed to get it and take immediate action based on it. But it's also essentially CC'd to every other bank in America. And so if your bank gets killed for misdeeds and misstatements that you have made, the document ordering the execution of your bank that gets CC'd to every other bank in America is basically a not so quiet instruction this shit will not fly, do not do it. You don't need to hear us tell you explicitly, do not do it, because if you do it, we will kill your bank. Signed, the Fed and every other investigative agency. people have an interesting sort of background belief that like regulators are naturally in kind of an antagonistic relationship with the regulated, where actually they're in like a quasi partnership and like a quasi trust relationship. And a thing I said on Twitter is that like bank CEOs in specific are kind of like the old British Empire sea captains, in that at sea is master and commander. They have been bred into this role. They have the full trust of the government, and no action of theirs on any Tuesday will be countermanded. However, if they screw up, the empire will descend with its full force upon them in a, like, let's snap your saber over our knee or etc. Tribunal later. It is not factually the case that there is, in most small institutions, a regulator watching every email or every wire or etc. that happens at the bank. They don't have the resources to do that. They don't want to do that. The banks don't want them to do that. A lot of regulation is ex post. And a lot of regulation, it involves like an ongoing dialogue with respect to, regulators like largely are above the level of particular commercial relationships a bank has. They expect the bank to have a portfolio of commercial relationships. They want to heavily inform the bank's thinking of how the bank assembles that portfolio and manages that portfolio. Versus like getting into the weeds of like, oh, I noticed on August 2nd that you paid out this money to this like one customer. I'm not very happy about that payout. Now they will get into that level of detail, but in the context of a larger quarterly inspection that says, okay, like I'm going to sample a couple of transactions from your bank, and you're going to walk me through how this shows that this plan that we've agreed upon together is getting followed on a day-to-day basis. And if that sampling comes through okay, then and we're okay with this plan, like yay, plus plus. Or maybe we're not entirely okay with the plan. Maybe we're not entirely okay with what we've seen coming out of the bank in the last couple of months. But we certainly don't want to kill the bank because there's a community dependent on you, and you haven't done anything that is like egregiously out of bounds yet. We'll say, okay, here are some comments that we have. Those comments are like kind of on an optional basis, and maybe we'll put them in a spreadsheet here. And here's some like mandatory issues and a timeline associated with them. We want those addressed by the mandatory timeline. Like an example of a mandatory issue. You can, many of these records are public, but like a bank might be told, hey, we took a look at your chief risk officer. And that guy, that's not the guy. Like you need some more seasoning in your risk department. It takes a while to hire a chief risk officer. We understand this. So you got 9 months. Come back in 9 months and show us more seasoning in your risk department, on the pain of our displeasure. And displeasure can mean a variety of things. And the nuclear option in the case of displeasure is we close the bank immediately, which is what the cease and desist letter did in that one particular case. And that happens very, very infrequently. It will happen very, very frequently if you hypothetically sell your bank to an offshore crypto exchange. Part of the purpose of the cease and desist letter is like, hey, things no bank should ever contemplate. In case you need this spelled out explicitly, this would be a bad idea.
Well, it's interesting that you're talking about how regulators maybe are inclined to move in afterwards, but it's like like you said, it doesn't necessarily have to be this bank that we're discussing, but in this case of Farmington and Moonstone, is you have a bank that, according to the Federal Reserve, if we believe what they are suggesting, when they moved their regulatory oversight from the FDIC to the Federal Reserve, they told the Federal Reserve, look, we're not going to change our business model. We're not going to do anything crazy. Nothing silly is going to happen, we promise. And then they did it anyway. And I guess if they're making this promise, and it's the only promise they have to make, you would expect, especially an entity as large and important as the Federal Reserve, to be like, okay, well, let's monitor that one thing then. But they didn't. And you go like, okay, so is the only time that they do this when it's too late? Is that really just, that's the only time?
In banking, I think that often happens is that there's various layered controls, and the promise itself is a form of control. like every contract in existence, even if there was no legal system to enforce a contract, just forcing people to come to the table and agree, this is the thing we will do, and this is the thing we will not do, that creates value because there's now mutuality of understanding as to what the expectations are. And so even if a promise is not monitored, that promise creates value. Even if the promise is not later enforced, that promise creates value. It is factually not the case that this promise will not be enforced. I would hate to doomcast like any particular person, but a thing that again, using the master and commander example, a British sea captain doesn't have to be explicitly told the British Empire, not a fan of piracy.
Now, privateering.
If you wander into piracy, and by the way, we will check if you wander into piracy, you will be dealt with most severely. That is the most basic thing that anyone who is a British sea captain, who has grown up in the English countryside at their family estate and has the proper breeding to walk into a court of admiralty, understands about the world that they live in. But if piracy is actually discovered on behalf of a Navy ship that is flying the flag of the British Empire, everyone involved will be dealt with most freaking severely, so that for 1,000 years, no one forgets that one does not do piracy under the British flag. Now, what could possibly happen to bankers who have wandered into doing extremely non-prudential things with banks under their control? One could only speculate.
They're ex-bankers.
They just don't do banking. Just don't do banking in the U.S. anymore, I think, is the real solution here.
That has not historically been the only punishment that can get handed out to people who have done not wonderful things to the banking system.
Yeah, but it's been a while since we sent anyone to prison for that.
Drug. Yeah, you want to do the 5-minute versions of stablecoins as a payment method? Acknowledging my cryptocurrency bias because I prefer my databases to be fast databases and not slow databases. Let's factor out cryptocurrency out of the stablecoin discussion entirely. Let's say we live in the Harry Potter universe and someone comes up with a way to compete with physical exchange of nuts and galleons. And they say there's a new spell and you can wave your magic wand and it instantly transfers money from point A to point B at a arbitrarily low cost. Isn't this going to outcompete the wizards who use their Visa credit card? And the answer is, well, it competes on multiple dimensions with Visa credit cards and with bank transfers in the UK or elsewhere in the wizarding world and with buy now, pay later and all the other things that a wizard has access to, including potentially other magic spells that could be developed in the future. And just the fact that it's instant and just the fact that it is low cost is not competitive with some of the other things because a credit card can make your cost of using it actually negative when you factor in rewards. The magic spell doesn't have explicit semantics around getting refunds, and you plausibly, if you are buying something from a company that you've never used before where you just Googled the name of the product, ended up on this random shop, it looks like a website, but can I trust them really? Then you wouldn't be inclined to magically wave your wand at them and transfer money over. Or, we define the semantics of the spell as being you wave your magic wand and money immediately moves from point A to point V. Is there a subscription capability built into this magic spell? No, because we didn't put that in the magic. And being able to bill someone on a subscription basis is enormously useful for a huge variety of commerce, from buying magazines to storing a payment method so that your checkout experience in the future doesn't have to involve explicitly invoking that payment method at all. And indeed, some of the best payment methods in the world on a lot of axes don't do very well with respect to the stored thing, and they introduce friction. And again, we can science out that friction and how much it costs businesses, and it turns out it costs a lot of money. And so there are businesses that would say, even if you hypothetically had the magic wand available, we would get more money supporting Visa and paying for the payments via the payments ecosystem than we would in taking free magic wand payments. The free magic wand isn't free. You have to be a member in good standing of Wizarding Britain to get a magic wand issued to you. And it turns out that the number of people in the world who have magic wands is canonically very small. And the number of people who have payment instruments available to them is very large. And if you are, Amazon, and you have a team of very smart people that are in charge of prioritizing 800 payment methods in the world and saying which one of these should actually make it onto the Amazon.com website, plausibly you would think, magic wands, there's 10,000 people in Britain that have them. those are a very small portion of our book of business relative to like buy now, pay later. I will prioritize magic wands very low on my stack. And then the people holding the magic wands are like, well, this kind of sucks. I can't use it to pay money on Amazon, even if it were free and instant. I can't use it to buy a burger at McDonald's, even if it were free and instant, et cetera, et cetera. I guess I should use the other 800 things that are competing for my attention. So that is the problem with stablecoins in a nutshell. It has been reported that stablecoin volumes are increasing massively, and this is a sign of real user adoption. I often think that cryptocurrency says, our slow databases are publicly available, and this allows you to verify facts about them, is greatly oversold. If this is true, then we are getting information about without loss of generality, like the FTX bankruptcy, at a time which is not the same time as those relevant facts were published to the relevant blockchains, which should give people some pause about how reliable the information is and how comprehensive and how many people are looking at it, et cetera, et cetera. But let's say, hypothetically, many people involved professionally in stablecoins believe that stablecoins are helping to bank people who are on the edges of the global financial system. Like maybe they are being used quite a bit for dollar-denominated transfers of value in various countries and without loss of generality, Africa. That's a thing that exists in the world. The edges of the financial system are kind of the edges of the financial system by nature. And sort of the oldest story in tech is that things start at the edges of the ecosystem. This is Clayton Christensen's creative destruction thesis. Like worse is better happens in various places, and existing incumbents don't look at those various places, and then eventually the thing that was worse becomes better in almost all the places and takes all the market share. You can believe that stablecoins are going to take all the market share in payments in the United States. There are some pretty huge structural reasons why that is extremely unlikely to happen, not least of which the United States government has an enormous stake in payments in the United States and would viscerally oppose that in a lot of ways, and would be a competitor that has a lot more advantages going to it than any random stablecoin team has. And often you hear central bank digital currency as okay, a government-backed stablecoin would be a really commanding entrant in the in the payments market in a particular country. You say, okay, well, a government-backed payment method, sometimes they are. And every payment method is government-backed to a greater or lesser extent because every banking system is government-backed to a greater or lesser extent. Bracket that out for a moment. In some countries, the government has, either through first party or through public-private partnership, brought a really compelling payment method to market, and that payment method has gained a lot of share. We talked about India, Brazil, for example. In other countries, the government has brought out a payment method and nobody cared and nobody came, and you still use debit cards or interbank payments or yada yada in those countries. Does the slow database make a government payment method better or worse? I contend that anywhere you can use a slow database, you can use a fast database, and it will have all the benefits of the slow database, but be faster. And people in crypto have often said, Patrick, you are being unfair. The slow database allows you to have this be an entirely trustless system, and trustlessness is a good thing. Trustlessness is not generally considered a good thing by the kind of people who make central bank payment systems. So it seems extremely unlikely to me that the product features around trustlessness or product features around an intense concern for privacy will be features of future central bank delivered payment systems in most countries that are of interest to listeners. That bit about privacy is interesting. Plausibly, we care a lot about privacy. But plausibly society cares a lot about other things too. And so, every other concern and value and instrumental goal that we have, these exist in trade-offs with each other. People in crypto don't believe this, but the institution that is credit cards in the United States are fairly privately protecting by default relative to a lot of other things you could do. For example, you can buy things on a credit card without necessarily having to give your address. That didn't used to be true about checks. They had your address printed on them by default. And you can, often have semi-pseudonymous identities using various payment methods where that did not used to be very capable. And so in future payment methods that gobble lots of share in the world, privacy will be one thing you can offer to users. Candidly, I think the financial industry is largely going to say, well, we certainly shouldn't do stupid things with regards to privacy. Actually, I don't know that all teams will necessarily decide that. There apparently are some payment methods that broadcast every transaction to a world readable feed by default. That strikes me as a extremely crazy decision, but like firms have made it in the past. But like most users, their revealed preference is that they don't make decisions in life based on what maximizes for like a privacy advocate's view of their privacy. They use Google for their email, not because they believe that nobody will ever be able to read their email at Google, but because like Gmail has a better client, because Google is a trusted brand name. I think privacy advocates broadly don't appreciate the fact that like Google is better at securing your email from both a random hacker and from, you know, a legitimate government authority than JRandom host is from securing your email in those cases, because they will have Google's resources backing up the response to a subpoena versus like JRandom host. So stablecoins taking over the world of payments, I don't see it. Willing to be wrong, willing to look at evidence. TikTok guys, we are 10 plus years into this, and a lot has happened in payments in the last 10 years, and very little has happened in the tens of billions of dollars invested effort to make slow databases the future of it. So if you want to change my mind, you are welcome to publish evidence to the internet and I will look at it. But you got to get people actually using the thing. And if you don't, well, then, there's a lot of fun toys in the world. I like computers built out of redstone in Minecraft as much as the next guy. They will have 0% market share in all cloud workloads in the future.
It's actually funny because we are almost exactly today 4 weeks out from the 9-year anniversary of the first stablecoin being issued. The very first tethers were issued in November of 2014, like November 9th or something. We're almost exactly 4 weeks out from the 9-week anniversary. They used to have a merchant API that was taken out at like month 6 for their stablecoin.
Yeah, and don't forget the ability to trade Bitcoin for US dollars.
Oh, I never forget, Cas.
So I think we are all peas in the pod with respect to our views on Tether here, but just for those in the audience who don't know, I once said that Tether is the internal accounting system for the largest fraud since Bernie Madoff. I think I wrote that in 2019 after years of looking into them. That is obviously untrue right now. They're bigger than Madoff ever was. I don't know that Tether was necessarily the first stablecoin. I think there were a few abortive attempts at like Basis Coin, et cetera, before that. But be that as it may, they're far and away the largest stablecoin to the enduring irksomeness. How do you say that in English? It irks legitimate businesses that are attempting to bring stablecoins to market that like the largest stablecoin in the world is operated by a criminal conspiracy, and that the largest stablecoin in the world is per the people at the legitimate competitors, like essentially counterfeiting the US dollar and then exchanging that for the reserves of the people who are attempting, pretending, a little bit of both at different times to comply with all the rules. I don't expect Tether to continue being the largest stablecoin in the world for forever. I also don't expect them to stay out of prison for forever. Madoff got, 17 years before getting substantially more years as a guest of the United States government. I expect they will eventually get what is coming to them, and it won't be 5.025% on a 2-year T-bill on the reserves.
I think that wraps us up. Thank you very much for joining us, Patrick. I highly recommend everyone listening check out Patrick's newsletter, Bits About Money, which we'll link in the description and on the website. And just one more time, thank you very much for joining us.
Thanks so much for having me, folks. You can find me around the internet. I'm Patio11 in most of the places, including Twitter/X and whatever they call it these days. If you like these topics, I write weekly or bi-weekly about them at bitsaboutmoney.com.